Hello and welcome to the 2020 Intelligence and Innovation Banking Summit. My name is Julianne Catalano. I am a Senior Sales Executive with Neuton.AI, a division of Bell Integrator. Thank you to everybody, each and every one, for joining us today as we discuss how artificial intelligence and machine learning is helping to pave the way. With that being said, I'd like to introduce our global CTO and moderator, Blair Newman. Please help me in welcoming Blair Newman to our 2020 virtual conference.
Hello, thanks Julianne, and thanks to all of you guys in attendance. I certainly value and appreciate all of you guys taking the time to be with us here today. Certainly I also want to begin to extend my personal thanks to all of our panelists that we have. I think we have an extremely good group that I believe will be able to provide you guys a tremendous amount of insights to what their experience has been so far as it relates to machine learning, specifically in the financial services sector. And more importantly, I think that we'll get some very unique insights as to how they've been able to begin to take advantage of machine learning, especially during some of the trying times that we've had as it relates to the pandemic. So joining me today will be Tony Hildesheim. Tony is the Chief Administrator Officer at Redwood Credit Union. Also joining me is Jason Schwabline. He's the Chief Strategy Officer at Alogent. And also joining me is Richard Lutkus, who is one of the partners at Seyfarth. And I believe that Richard brings a very unique view or lens to our discussion here today, because he's one of probably the only individual that I've ever met that is not only an ethical hacker, but also an active attorney. So I think that he gives and brings a very unique perspective along with Jason as well as Tony. To give you an overview of our agenda today. So we'll start off briefly with one of our partners who we're extremely proud to collaborate with, Google. And so we'll start off with a brief discussion with Google and how we're working with them today and some of their insights that they're bringing as it relates to machine learning, specifically in the financial services area. And then from there, we will move on into our panel discussion, which is really, I believe, is the core of today's topic, where both Tony, Richard, as well as Jason will provide a tremendous amount of insight into their experience. And our objective today is really to make this particular summit as interactive as possible. So how we plan to look to achieve this is throughout our panel discussion, we will be engaging all of you guys in a series of different polls where we can gather your insight and also incorporate some of your feedback into some of the discussions that we're having right now. So throughout our event, you should see a number of different polls that will come up that will allow for us to get your insights and bring some of that to today's discussion. Then from there, we have a section, what I like to call Innovation in Action, where we'll take a moment to share with you some of the experiences firsthand that some of the panelists have had as it relates to leveraging machine learning in their respective environments. So to just start briefly, I'd like to introduce Shodney. Shodney is one of the forward-thinking leaders inside of Google. Specifically, she's focused in the financial services area. And we'll start off just briefly with a couple of questions to Shodney and to get some insights as to what she's experiencing in Google and what Google is looking to do moving forward as it relates to machine learning and specifically on the financial services side. So Shodney, I would like to welcome you. And I have a couple of different questions. It's a pleasure to have you, and thank you for taking the time to share your insights. So I have a couple of different questions that I like to start off with you just to kind of get things going. And so at least in today's market, especially now with everyone working remotely, We're becoming more and more dependent, let's say, on mobile devices, wearables, whether you want to consider IoT, edge devices, et cetera. And now with the rollout of 5G, what is Google's view of today's market, and how does this all relate to machine learning from your perspective, specifically as it relates to financial services?
Yeah, thank you. Thank you for the question. I would say the new things that you talked about, like 5G, IoT, wearables, and so many new things that are coming, definitely they are very important for all industries and specifically for financial industry, because when you're talking about something like 5G, right, you're talking about super fast mobile broadband, then you're talking about like very low latency communications, you're talking about reliable ways of talking. And what that really relates when we're talking about something as a product or something to derive insights is huge amounts of data, various insights to be driven, because when the latency is low, you have more flexibility to derive a lot of insights, and that relates to people, like even when you're talking about IoT, right? Like for example, I'm wearing my Fitbit watch. I know that's not financial services, but that is a IoT device where it's tracking everything about me, like how much I'm walking, how much I'm sleeping, what is my heart rate, and so many things. So all of this, how this relates to machine learning is basically they are all going to indirectly directly pump data into systems, and that data, when we derive patterns saying, like for example, I'm very healthy when I sleep for like 8 hours a day, and that is really giving me a good sleep score, right? And when we're talking about network, when we see that whenever mobile phones are using 5G, they are able to give more metadata than usual 4G or 3G. That's helping users say that, yeah, this person was at this point in this place and what all they used it for, and so many things, right? So they all give insights, and machine learning, as we know, is all about driving insights. So they all indirectly help machine learning as a whole. And specifically for financial services, all, like whether it's not just devices or wearables, even network, they play a huge part to give users insights.
Yeah, thank you. I certainly can think and imagine, and this is one of the things that we've previously had some experience with, that just as a consumer and you're walking down the street, especially let's say with 5G now, and you're maybe potentially, whether you're walking past a financial institution, and a financial institution may have some relationships with different retailers that are out there that you're able to provide, let's say maybe instant discounts, instant incentives to engage the consumer. And I have one more question for you, specifically, I would say around the pandemic or COVID-19. I mean, what are some of the trends that you guys have been seeing in the market, specifically, again, as it relates to machine learning? Because from my view, everything has kind of went through a fairly seismic shift. And for all intents and purposes, I imagine there's a lot of pressures on different financial institutions, specifically around the brick and mortar locations. And I'm sure that Tony will probably be able to provide some insight into this, but are you able to provide some insight as to maybe what Google is seeing as it relates to the trends, especially as we look to hopefully soon be coming out of the pandemic? How do you see machine learning playing a role there?
Very good question. And for that, I would like to say that in general, cloud adoption was anyways happening, like pre-COVID world, as how we want to call it. But because of COVID, the cloud adoption, the digital transformation, they all have accelerated, right? Because now it's a virtual world where we all living. We are not like recommended to work together like in physically presence, right? So we want everything to be online, to be accessible to people. People can collaborate. Efficiency should not be affected, as we would assume it should have been because of COVID and work from home practices. So something that I would like to share as some statistics of market trends, like specifically in financial services, there are so many documents, right? Whether these are like insurance documents or bank documents, like even images of receipts and so many things. So what we have noticed that in general, almost 80% of companies, they used to have very low visibility in these documents, like you can say paper documents or pre-written text, images, or unstructured, data in general. And almost 50% of workers' time would go just to make sense of these documents. So that is a huge number. And because of our focus in financial services, we have been investing in products like Document.AI, for example, where we don't want people to spend so much time in just making sense of text, but actually to use something which is automated, something which is easily available, and something which is also low at cost and requires very less manual efforts to make sense of these documents. That's one thing. Second thing is something which I think most of you all will relate to is, I'm sure many of you would have called some customer care services, specifically due to COVID. Maybe something like canceling a ticket, or maybe some transaction which have not gone so smooth, and you want some insights on that. So during COVID, we saw like immense, spike in customers' call centers and people who would be responsive for these customers. So, like end clients. So we brought something like as the, COVID-19 rapid virtual response product, which is actually an extension feature of our existing Dialogflow product. So not really talking about the product stuff, but just want to highlight that this was another area where we saw many banks, many financial institutions, and even non-financial institutions leverage products, what we offer during COVID, to really help these customers get rapid response. Because due to COVID, we also saw that customer expectations really changed. Like people were like, we want answers 24/7 and we want answers as soon as possible. There was also high risk of churn if we were not able to give that response. So these kind of just shift our, the whole motivation to dedicate more towards these kind of solutions.
All right, well, thank you for that. I really appreciate you joining us here today. And I think you raised a couple of key points, especially when you begin to talk about COVID, more and more of a shift maybe to using the mobile phone, more and more, let's say, online and digital documents. And I think Richard will also be able to provide a lot of insight in regards to that. But when we also begin to think about, let's say, mobile usage, I think that when we look at our panel today, as we begin to move into our panel discussion, I think we have some very unique views, and that Tony will be able to provide us a pretty good view from, let's say, what he's seen, as it relates to his institution. And then I think Jason will subsequently be able to bring a very unique view, because he kind of sees everything from a horizontal perspective, and being able to see, let's say, maybe have some insight as to, let's say, customer or member movement throughout this time, I think will be very valuable. So thank you again. And I'll like to take this moment to just kind of thank you, to transition to our panel discussion at the moment, and bring in Tony, bring in Richard, as well as Jason. So as we move forward with the panel, welcome, gentlemen. And we'll start off with, let's say, just a kind of maybe a simple question, brief, starting off with you, Tony. Why don't you take a moment to tell us a little bit about yourself? And if you don't mind, why don't you include a fun fact or something that's interesting that maybe most of us don't know about you?
Sure. Yeah, so Tony Hildesheim, I've been in, unfortunately, the technology business since 1980, and for everybody else, I've been around for a while. And it's interesting to watch how things have changed. I'm with Redwood Credit Union. We happen to be a $5 billion plus, actually I think we're pushing $6 billion now, dollar asset size financial institution, which doesn't mean a whole lot, to be honest with you, when you look at how people count their assets. What really matters is we serve about 350,000 members, and in 5 counties in Northern California, just north of San Francisco. So we have a lot invested in knowing our member, understanding who they are, understanding what they're looking for. For me, a little bit fun fact, I guess. Well, I play the guitar, although when my daughter was 7, I used to play for them at night when they went to bed. And my daughter, when she turned 7, looked up at me one night and said, actually, I think she may have been 5, and said, "Dad, please don't sing." So while I play the guitar, I can't sing to save anything. So fun fact, I can play a guitar, but I can't sing.
All right, all right, all right. Well, thank you, Tony, for joining us. Let's move over to Jason. Jason, why don't you tell us a little bit about yourself as we get started?
Hey, Blair, thanks. My name's Jason Schwabline, as Blair had said, and I've been, as Tony said about technology, I've been, I'll say lucky enough to have been in financial services for over 20 years. Joining the financial service industry was almost a happy accident. I worked for a data center, old term processing facility, and they just happened to start wanting to migrate financial data from microfiche to actionable data. And being able to exchange and stuff. So I was lucky in the seat I had related to that, and it grew from there. You know, as we said at the beginning, I work for Alogent. Alogent is where it provides a really unique insight from my view, at least, is because I've been able to be lucky enough to be part of core banking technologies, peripheral systems, creating new tech, things like that. And where we sit, we're a small organization when you look at company size, about 220 employees and growing. But we service over 2,400 financial institutions inside the United States, Canada, as well as the UK. So when you said about the horizontal view, we're able to see a lot of transactional activity, but not just transactional, right? Because our business pivoted from a more legacy transactional model with documents and checks. You know, I was thinking about what Chandra had said earlier, and more to a digital platform and what we're doing. So we've went from seeing transactional behavior to now consumer behavior and business behavior, as well as knowledge worker behavior. So it's been really unique for us. A fun fact for me is something that I guess I put inside all of the Alogentonians know about, but I wanted to be a ninja when I was a kid. I haven't met lots of other people who want to be a ninja. So like kind of like Tony and his guitar story though, with my kids, whenever I've had to correct them as they get bigger, they're like, "Are you going to go all ninja on me?" And they do something like that. So that's as fun as it gets in banking, I guess. Blair, sorry.
Well, the key question is, did you start your training or not?
For you to find out. Let's see how this goes.
All right.
Thanks.
All right. Well, thanks for having you here. I really appreciate it and look forward to your contributions in our discussion today. And let's move on to you, Richard. Tell us a little bit about yourself. I kind of spilled the beans a little bit, but why don't you go from there?
Sure. So, as Blair introduced, Richard Lutkus, I'm a partner at Seyfarth Shaw, based out of our San Francisco office. And I'm a lawyer, as Blair mentioned, but I'm also a technologist. So I'm certified ethical hacker, certified digital forensic expert, certified eDiscovery practitioner. I'm an attorney who codes, as you can probably tell by the certifications. My practice at the firm is really based on cybersecurity, digital investigations, and eDiscovery. So I actually service and work with a lot of banking clients, some of the, anything from the larger, household name banks down to smaller, credit unions and regional banks. And, through that, I get to see a lot of what they do. And I also get piles and piles of their documents to deal with in litigation. So it does kind of afford me an interesting, opportunity to kind of see how they operate, at least on the legal side. And I'll talk a little bit more about how that works with machine learning later. But I think Blair wants me to tell you a fun fact. So I had two COVID hobbies. Well, I guess one project and one hobby. So at the firm, I actually developed a software that allows off-network collections of data from remote worker computers to comply with legal hold obligations and investigations. So that was my kind of work project that I focused on during the lockdown. And then the second one, to keep myself sane, was my wife and I took up sailing, and so we did like an intensive. I think we're at like 8 days of sailing training. So we kind of graduated and took these exams and things. And I literally have only been on a sailboat one time before March of this year. And now we're like captaining 40-foot sailboats. So I tried to make use of that as best I could.
All right. I'll be looking for my invite soon here, just so you know.
Yeah, you're not alone in that, Blair. I was just thinking, wow, all I did was plant the garden like the rest of America. Wow, nice work, Richard.
All right, well, let's get into some of the discussions for today, and let's start off with a fairly yes or no question here that we have. We'll start off with you, Jason. So yes or no, do you foresee that machine learning will become a staple technology and service in the financial services industry?
Oh, yes, wholeheartedly.
All right. And Richard?
Yeah, I think it's already being explored. Some of the banks that I've been working with, I know, are already exploring machine learning in a lot of different ways. I know we've used it in the context of litigation, but outside of that, in their operational side, I know that they've inquired with us about our experience with certain machine learning software to determine, whether they can use it, for their actual operational side of kind of looking at trends and invoices, and also finding interesting, I wouldn't necessarily say looking for fraud, but I guess they could do that with like the credit card side. I think a lot of them are using it to look at trends and also provide their consumer clients with more insights on where their spending is and things like that, to kind of say, hey, if you keep saving at this rate, you'll do these things. And I know that may be simplistic, but I think there's a lot of push to do that, to help people understand like what their actions do and how they impact their long-term goals.
Okay, all right. And Tony, what about yourself? Do you foresee machine learning becoming a staple in the industry?
Well, of course. So to kind of put it out there, machine learning is happening in banks and credit unions right now. I think Richard kind of hit on one of it. If you're looking at cards, there is machine learning that's used to detect fraud on cards. It's not by accident that they know when you're doing something different than you normally do. That's all machine learning. And then it gets deeper than that. So there's several in the fraud areas. One of the first areas where you see machine learning that's already being deployed. The reality is we're going to see a lot of it because at the end of the day, what people don't really realize about banking is it's a behavior issue. It's not just transactional. Transactional is an easy thing to calculate. You can do trend line and you can do a lot of predictive analysis around transactions. But what you're trying to get to is behavior. And so when you kind of step back from what we do today and where we need to go, today we're really good at looking at the trend line and saying, here's what we think the transactions are going to do. And everybody was caught a little bit surprised that, well, maybe they weren't surprised. At the beginning of COVID, we had a huge dip in, auto purchases and in loans, but it's actually rebounded. And what's interesting is if you could have predicted that behavior shift that happened midway through, you would have realized, well, who would have thought that in the middle of the pandemic, people would be buying RVs? But that's one of the biggest things being purchased right now, RVs and trucks, full-size pickup trucks. Why that? And could machine learning have helped predict that to then help position the financial institution to be able to take advantage of that wave that was happening or that is happened? So I think machine learning will absolutely be embedded into financial institutions. They're going to need it to predict behaviors, which is much more difficult than trend lining transactions, but it's already here. So we use it a lot for fraud detection. And I know for a fact that Visa and MasterCard both have very, very deep machine learning systems, primarily to detect fraud, but also now looking at card behavior. And it's really about behavior. It's not just about transactions anymore.
Yeah, I've also noticed, at least for myself as well, that even the housing market has picked up quite significantly as well. So let's as I mentioned, we'll be making this interactive. So we'll start with our first polling question for the audience as we begin to kind of transition to our next question. And just to make note that I certainly see some of the questions that are popping up in the chat, and I will certainly incorporate these as we move forward. Some of the topics or questions that are being asked, we do. At the time, we have some similar questions that are scheduled, but rest assured, we will make sure that any of your questions, or even to some degree, if you guys might have any counterpoints to what you might hear in the panel, certainly feel free to use the forum to raise those, and I'll certainly make sure that the team addresses them along the way. So as we get we'll be wrapping up this poll in just a moment, but I want to phrase one of the questions to you, Tony, It's a little bit off script, but it's one that we got in the chat, because the next question is really around, what was going on, and when and how did you begin to see, let's say, the different impacts, specifically, around COVID, that really kind of begin to give you the impression that, that maybe you need to pivot, and you maybe need to begin to look at things in a different lens. I say this because, of course, I know that you've been looking at machine learning. You started to begin to implement machine learning in your environment. You mentioned some of the insights that, would have been fortunate for you to have some, at the beginning of the pandemic. But what was that point that where you began to say, hey, as an organization, we kind of need to make this shift and begin to apply some of these forward-leaning technologies?
Sure. Yeah, it was long before COVID. COVID just, like everything else, COVID kind of expedited some of how people started deploying some technologies. You look at just what's happening with video today. Up until this point, people have talked about video. They talked about video banking. They talked about video meetings, talked about remote workforce, but now it's fairly ubiquitous. That's just what you do. But long before COVID, we had started looking at data differently. We really started thinking about data from a variety of perspectives. Banks and credit unions and most institutions are good at looking at, what I like to call isolated or single stream points of data. So they say, well, let's look at our loan portfolio, look what it's doing, or let's look at our transaction set, let's look what it's doing. But you really have to step back from that and look at a variety of perspectives of your data. It's not just good enough to say what's happening with transactions in the branch. You really want to understand, well, what kind of members are coming into the branch? What are they doing when they come into the branch? Transactions, just one of them. It happens to be one of the fewest things they do in branches, believe it or not. They do most transactions in online. We definitely saw a huge spike in mobile. So we started looking at data from a variety of perspectives and really trying to look at it by pulling in different data points that may not actually from the traditional sense have a lot to do with each other. But if you can put those two pieces of data together, you can actually start driving out what the behavioral trend is that people are having, and then you can start making better decisions. Instead of just assuming that everybody who joins the credit union or everybody who wants to deposit a check should have the same hold as everybody else, for instance. Well, why do you assume that? If you have enough data, you can actually determine what's the risk of that deposit. And deposits are kind of a big thing, especially if they're all happening online now, which vast majority of our deposits are happening in mobile. So if somebody's depositing a check in mobile, the first thing we want to know, is that a good check or not? And so to determine that, you got to understand the member and say, well, is this a trustworthy member? Or for banks, is this a trustworthy customer? And then you can set holds or limits based on that individual versus just based on a transaction, which is really what all of us should be striving towards. Let's look at the individual and understand that individual's behavior. In order to do that effectively, you really do need to deploy some fairly robust and complex and fast systems to come up with your algorithm or with your answer. And in our case, a risk rating that's not just risk rated on the transactions, it's risk rating the individual as well as the transaction. And so you think about those two perspectives, they're very different, but they're critical to the consumer. So think about the consumer. They have a check they want to deposit. If it's their payroll check, they want that check available immediately. Well, how do you know that it's a payroll check, and how do you trust? And that's where data becomes extremely valuable. That's just one example. And I know somebody asked a question about explainability, and I think they're talking about mortgage lending. How critical and how valuable would it be if we could get rid of credit score as the primary driver of a rate? And I think the answer is out there. It's really not about the credit score. It's about what's their likelihood, or what's their behavior going to be in paying back this particular loan. And if it's high, regardless of its credit score, then wouldn't you want to give that person the best rate possible, for instance?
Yeah. And Richard, let's come to you. If you can provide your insight as to maybe what you've seen from your side.
Yeah, I think, and I mean, what I've seen in my industry is really extreme cost pressure by clients, and it includes lots of financial service companies, but a lot of cost pressure to reduce spend on litigation. And so we've seen, well, I guess I should give some background for the benefit of everyone on the group on here. A lot of what happens in litigation is the exchange of documents in what's called discovery. And part of that involves review of documents at a large scale. We're talking sometimes in the millions. And one of the most expensive parts of doing that is determining whether a document contains attorney-client privilege or work product. And if it does, you have to hold those back from being disclosed to the other side. Typically, that is one of the most expensive parts of the entire process. And so what we've seen is an adoption of machine learning to both determine if documents are relevant to a case and need to be turned over, but also whether there's a likelihood that the document is actually privileged and should be withheld. And so when we first started looking at this technology, the question that came up was, how do we trust it with something so important? Because if documents go out the door, it could be potentially very damaging to our case, even if we have the proper legal mechanisms in place to recall those documents. You can't really unsee something, even though ethically as attorneys, we're not supposed to use that. It's very difficult, especially with some practitioners who may not follow that to a T. So what we started doing is testing machine learning against actual human performance in blind studies, where we ran a machine learning program in parallel with actual humans, and then started measuring the results over time. And they didn't know it was happening. It was kind of, we just did it on the side to test it. And we found in every case we've done the proof of concept in that it's been more accurate than the human reviewers. And on average costs half to maybe a quarter as much to operate and get results. So, you know, in terms of what are our clients looking for when we say, well, these are the most expensive parts of your litigation, and they say, well, how do we address this? And so we introduce machine learning technologies to them. And so I think the first, you know, what we're seeing is some more adoption of that, and it's still very, very low overall in the legal industry, but you're starting to see the use of machine learning to categorize documents, to classify things, to make it easier for people to look through huge volumes of data. And, you know, for example, this month I put 12 million documents through machine learning for my cases. And it's become, for me, something I recommend in every case, just because it does have such an enormous impact on cost reduction and quality and avoiding risk.
Okay, all right. And Jason, to wrap up with you on this question.
Yeah, no problem. I think it's a bit of, my view is it's a bit of a hybrid actually in what you just heard, because for me, I think the inclination of machine learning and AI and the whole ecosystem of it is around problem solving, right? And so when we talk about problems, we're talking about solving a problem in a consumer behavior, or we're solving a problem in the documents that Richard spoke of. It's not something that just happened to us, right? We know digital acceleration has occurred. You see, you know, you read different things quantified, you know, so most are sticking to say, you know, especially in financial services space, in the 5-year range, right? They accelerate it in the 5-year range. But in that, you know, we solve problems, but with it, banks and credit unions in this country work with a lot of pressure for efficiency. So how do we constantly do something more efficient and not give up quality, security, all of the other pieces? So I think as you start to see the change in technology occur and the digital impact occur, what it did was create magnitudes of efficiency. I joke sometimes it's created magnitudes of opportunity that you can compare the opportunities of efficiency for. And that's not just looking at cloud expectations or anything like that. You know, different things, drivers with latency in cloud versus on-device processing, all that changed over time. But you know, very, very akin to what Tony has said, something as standardized and normal as a credit score. Wouldn't that be nice if we went away and you just judged on consumer behavior? I mean, one of the things we had threats in the financial service, I'll just say threats depending on how you read about it, was, you know, consumer-based lending, community-based lending, people basing it on knowing each other, what's occurring between, you know, the communities they live in, things like that. there's no reason why we can't reach a level of that sort of normalization of knowing the behavior of that person in order to say, hey, you're trusted. And I'm going to lend something to you, and I'm going to help you build inside your community.
Yeah, I think that's a good answer, especially when you begin to think about, let's say, a number of different thin clients that are out there, especially whether it's millennials, Gen Zs, et cetera. They don't have a thick credit file. And machine learning certainly lends itself to being able to pull in a lot of these different external features and include them in your rating of a particular customer or member. And going into our next question, I know we did have one of the comments in regards to explainability and importance of explainability. At least so far, what we've seen, not only working with Redwood, but explainability is really essential, especially in the financial services industry. Being able to getting yourself to the point of doing a prediction, I certainly believe is one thing, but also being able to explain it to the business why your model made such a prediction is fairly essential. And I know that's one of the tools that we've been able to include in our solution is a fairly robust explainability office where we're allowing for our customers to not only identify, let's say, the top 10 features that are important to the prediction, but also the bottom 10 features. We also make sure that there's an exploratory data analysis. And we have a particular tool that I know that Tony's organization has found to be very valuable, which we call the model interpreter, which allows for our customers to dynamically change the values of their features to see how it may influence a given prediction. So explainability, I can certainly say, especially with working with Tony's organization, is actually key and essential. And so, Richard, you mentioned that, and if you can briefly, you mentioned that you yourself, you're using machine learning at the moment. If you could just briefly just comment on what were some of the most important factors that you considered when you began looking at the tools that you were going to use as it relates to implementing machine learning in your environment?
Sure. I think paramount was trust. We needed to know that it was doing what it was set out to do, and that there was a high degree of accuracy. As I mentioned, not where I come from, a lot of people want to put eyes on every document just to have that feeling that a human has seen it and it's not going out the door sight unseen. So one of the things I always have to talk about with clients is, how do we know it works? How do we validate it? And so I think trust is probably paramount to all of it. And being able to explain to them and potentially to a judge down the road of how did this decide these things, and being able to substantiate your use of it and to really back it up is important. So I think to your point, having the ability to describe it to those who are the recipients of the output in a way that makes sense to them and gives them some feeling that what they're receiving is actually good and valid, and that just because it came from a machine doesn't mean it's any worse at all, and in fact is better. And so it depends on your who's the recipient of that information, whether they will understand that that the output from machine learning is and many times better than what a human can do, either higher quality, less errors, or less expensive, or a combination of those.
Okay. All right, Jason, I know that we've had some discussions. I know that machine learning predictive models is certainly something, especially for your organization around the digital banking side. What are some of the more important things that you're considering at the moment?
I think it's really easy to put into three quick categories for you. One is about scalability, scalability of solution. And I don't mean that in the overused term of, do we have enough servers in a building? What I mean about scalability to get the immediacy of this data to you, to be able to model it, to be able to look at and react in it. One of the major things that's been a pet peeve of mine in the entire industry for years is we're really good at getting data in a siloed behavior, and then we can report on that data, but how do we act on the data? Being able to tie an action directly as a direct correlation to something in how we maintain that data, I think is very important, and how to get there quickly. I think in that, what we see is, in technology, we always measured ourselves like an example like Moore's Law, right? We knew every 18 months, we would look at how computing power would impact what we were going to do. There was an awesome article in the Wall Street Journal in September around Huang's law, right? And its implications in AI and the GPU and its presence, and how the GPU is now the democratizing factor in a lot of theories related to how quickly this data can be interrogated. So having people look at things related to that, I think, is very important. I know it is for us, because we want to recognize that data is no good when you action it from a stale point of ability, and then when you can't do anything else about it, like your time of the essence is there. I think another part of it for us is around trust of the integrity of the data, just like Richard had said. But third, I think, is very important when you mix it with that preponderance of what goes on in privacy, in the scalability portion, is around privacy. We are trusted in the financial services industry, and monetization of any of our activities creates a different sphere of trust that you need to look at it. People look at you through a different lens when you're handling financial data. So, not to be jovial about it, but not to be creepy with it, right? How do we get the data and the actions in the hands of the knowledge workers, so let the financial institution do something, but also be able to have something so it touches the consumer? I mean, we're really unique that we could do that. So I think it's about considering the knowledge worker of where that data is going to rest. And the knowledge worker could be a consumer, not a bank or a credit union employee as well.
All right. And Tony, why don't you give your insights as to what you've considered to be some of the most important factors in choosing your tool of choice? And then also, why don't you begin to elaborate on some of the use cases that you're looking to implement moving forward? You're on mute, Tony.
I forgot I put myself on mute. Not that I was, Yeah, so Jason and Richard actually answered a lot of the questions about what are some of the most important factors. Relevancy is probably one of them that people don't think about. Everybody looks at these. It's fascinating when technology comes out. People are like, oh, we're going to do everything with it. AI. Oh my gosh, we're going to do everything. The reality is there's some relevancy factors. What's real? What can you actually do with it that's actually going to make a difference? And so relevancy is probably one of the biggest questions. We're really good at doing predictive and even statistical analysis, but beyond that, when do you actually need AI, and when is it actually going to make a difference? And then, are you going to use it for an ethical purpose? And then, is it going to be relevant to the end user? And for us, that end user happens to be our members. So we can do AI all day long, but how relevant is going to be? I think one of the biggest challenges is not getting sucked into the hype and really focusing on what it can actually produce for you and what that product can actually provide that will have meaning for those that you happen to serve it as a business. And for us, that happens to be our members. And so we're looking at a variety of engines. And to be honest with you, most companies have sharp people that work for them that can do statistical analysis at some level. But beyond that, what they really need is a partner that has a tool, that has expertise, that can actually apply the right question to find the answer. And finding that right question up front becomes really the most important factor. If you ask the wrong question, you'll get an answer, but what are you going to, is it going to actually solve the problem you're looking to solve? And all too often, people are asking questions that they want AI to solve, but it's the wrong question. And so for us, we've been really focused on what's the right question that we need to ask to get to a solution. So everybody looks for, there's in the banking world, there's 3 or 4 kind of holy grails. One of it's next best product or next likely product. I'm not sure that's the right question. It's really what's the next needed product, or what's from the behavior of the member, what's the thing that they need the most next. And so how do you drive towards that versus the next thing I want to sell somebody? We're more interested in finding out whether they need, understanding, and then being able to offer it at the right time for that particular individual. The other area that's kind of holy grail is attrition. Everybody wants to know, well, what causes somebody to leave the credit union or bank? They join, they get a loan from you, they start their savings or their checking, and then all of a sudden they decide they no longer need that particular fund. Why? And then how do you predict that? And how do you actually, instead of just predicting it, how do you see those trigger points and intercept at that right moment to make sure that, one, they stay a member, that we're providing a meaningful service to them? And that's really the answer. financial services becoming very democratized. I mean, you can get it from heck anywhere. I swear, Kellogg is going to start selling it on every box of cereal. It's that out there. So much is out there these days. So what makes it meaningful for a member to stay a member of Redwood Credit Union? For us, it's that we're anticipating their needs and we're finding the solution that helps them with their financial lives. So if we can use AI to help us drive that, that's one of the things that's going to make us successful, because it's going to make our members successful. So we're looking at several of those types of things. We're working with your team, Blair, on attrition modeling and next likely transaction modeling, because that'll help us drive to the next likely product they need. We're also looking at a risk model that allows us to give more access to the member to either credit or their financial services based on a risk model that really takes into account their behavior. And then finally, we're really starting to think about modeling a behavior that allows us to offer financial education to our members. And I think somebody started talking about that earlier. It's not good enough anymore just to have a Quickens or Yodlee type PFM, a financial manager that categorizes your spending. At the end of the day, most people don't really care, and they categorize them into 1,000 different categories. People really care about 4, maybe 5 different categories of spending. What they really want to know is what's coming up, and do I have enough money to cover it? Do I have enough money in my emergency fund? How much should I be saving on a monthly basis for retirement? They want those answers, and they don't want to have to work too hard to get them. How do I create a budget that's meaningful based on my spending patterns, but also then use that to drive better savings and better management of my finances, so that I'm ready for emergencies, or frankly have the funds that I need to buy the car that I need, or to take the vacation that I want, or to help my kids go to school. Because frankly, nobody wants a loan. Nobody wants a credit card. They want a home. They want to have emergency funds. They want a vehicle to take themselves to work or to kids to school. They don't want a loan. They want to be financially savvy with how they spend their money, and they want to be financial savvy with how they use products and services to meet their needs. And their needs are not what the services. Our services are just a means to an end.
Yeah, it's very interesting, and apologies. I'm gonna ask the team to just pull up the polling question. We forgot to do it, so we'll do it now. So if you don't mind, put up the polling question. But as the polling question comes up, I want to just begin to kind of prep a question for you, Jason, because I'm really kind of keen and interested to get your view. So Tony, I think, really gave a pretty good view as to the wants and needs of his organization. But I'm really keen to kind of get your view, because as you've mentioned, Alogent is servicing a number of different institutions globally, right? And some of those institutions are, community regional banks, and they're most likely receiving a lot of pressures from some of the larger financial institutions, for some of the fintechs. I mean, you name it. What are some of the use cases that you guys are looking at? Because I only can imagine that your customers are coming to you and saying, hey, Jason, how can you help me be more competitive in this market? So when you're thinking about the use cases that you're looking to implement, how are you looking to empower your customers so that they can be more competitive? What use cases do you have in mind?
Oh, no, good question, Blair. I think if you separate the knowledge worker commentary that I made earlier, we're at one point servicing the needs of the banks and credit unions. So we're lucky enough to get, as we started with, a very horizontal view of that data. So having that horizontal view of that data, where I see an opportunity, for instance, is, I think it was Tony who mentioned earlier, around looking at things in a particular silo of that data. So saying, hey, what's going on in my mortgage portfolio, or what's going on with this, and matching behavior. I think taking that sort of data and looking at the deposit activity, aging of accounts, where the person's transacting from, for instance, home locations. have an interrelationship with a small business, and there is actions according to there, because the majority of small businesses in our country are starting from micro businesses, and these people are working from home right now. Being able to parlay that into a multitude of services, but also helping the institution know their customer a little better, and knowing their customer allows action, right? So you could do everything from use cases that we see a multitude relate to advertising, and I mean subtle advertising. I don't mean throw a banner, click through it, have a good day. And a banner that means something to somebody. So, akin to what Tony had said, you talk about spending habits, for instance, and you see what someone's doing. You see the life cycle of the member and where they are. There could be interrelations to cars being paid off, could be relation to homes being moved, second homes, college, things like that. To be able to follow the life cycle and be able to work and suggest inside the behavior of that consumer, they would maintain their relationship with you throughout their entire financial life with you. Yeah, they'll supplement with some other components, but you can bring that in because everybody's going to maintain that. Lending, for instance, is for me, it's really easy to always look at that way because there's a preponderance of data around behavior, and you can see how people are acting with their money or responsibility, but also you can also tell when they need money to lend, right? You can see consumer behavior going on and maybe a way for their trusted partner to check on them inside a financial institution and do that. You may sign people in and realize, predict the behavior related to the channel they're going to work in. We always talk channels in financial services, but, there's in-person, there's ATM, there's digital, there's a multitude of that, but how are they going to interact? And a lot of that for me is around automating that, right? Taking that piece of data, because I think one of the pieces we talked about, for instance, around seeing what happened inside this digital acceleration was, we saw behaviors with customers to where, normal running of concurrent logins in a digital banking application is 35–40%. We saw peaks on given days in the 80s. People, the majority of the membership in an institution were logging on. That was related to an activity that we found out was a correlation directly related to a pay event that was occurring inside somebody who was also getting distributed funds related to PPE loans and other things like that occurring right now, right? So imagine that story of predictability. Take that all the way through, and like Tony had referenced about certain things you wish you could predict, even inside what we're seeing inside today, there's reports around the used car market. And because transportation is now not as accessible to people, at least from a safety point of view, what we're doing is everyone is going out to buy a used vehicle. So seeing those numbers go in price, it changes the complete financial model of what we're doing. But I think that the great part about this is around, can we provide assistance to the financial institution working with their membership, but also to the consumer? Because that's also one of the things that's gone away a little bit. Video is really great, but we remember a lot of people that are in this current generation, while branches were shrinking, the reason they were going to the branch, people that were the college age groups and stuff were headed because they needed financial advice. They felt there was a person there that communicate. If we can take a digital presence and start to become an advisor, a responsible advisor related to that, I think that would just completely be awesome. We could change a lot that way.
Okay, excellent. And so I'm gonna ask the team to pull up another poll as we kind of move to the next question. And this one is a little bit more geared towards yourself, Richard. So as the poll comes up, I'll kind of give you some introduce the next topic. So from your perspective, and I'm sure you have an opinion, when you begin to think about, let's say, artificial intelligence, machine learning, especially, let's say, from the cloud, what are your thoughts as it relates to cybersecurity, compliance, privacy? If you could briefly kind of give your insights as to maybe what were some of the headwinds that you've experienced with your clients and how you address those, I think the audience would find that valuable. So if you could briefly give some insight in that area.
Yeah, sure. So machine learning is already being used in cybersecurity pretty routinely. And there's a couple different areas, actually. The first is detection. And this gets back to what Tony and Jason are saying about behavior. What are we seeing that is abnormal behavior for a given computer or a given login or given network traffic? And so what the software that does machine learning and cybersecurity is looking at is trying to aggregate logs and determine, hey, is this activity something that we think is high risk? And then there's kind of a push to create systems that are automatically capable of making decisions at some level based on a risk ranking and take action based on those. So you see it kind of in the upfront, the cyber defense and detection. And then we also see it on the post-breach work area, where you have a body of data that was accessed by a threat actor, potentially stolen, and you need to really evaluate that body of data for to determine whose data was it, what data was in there, and really quantify for each of those people. Try to determine what jurisdiction the laws apply, and then notify them. So if you have, let's say, 100,000 records that were accessed, we need to find out who the people are, what their contact information is, what information was actually in there. And then, based on, we use machine learning all the time to find PII and financial information, to then kind of put together, hey, for each of these people, what information do we have? And then from there, we have to do an analysis to say, okay, based on the jurisdiction they're in, does that combination of records that we found for this particular person rise to the level of actually doing a breach notification to the Attorney General or to the affected individuals? And so it's used pretty regularly in cybersecurity and privacy to try to really respond quickly and effectively to these. I mean, some jurisdictions like the EU, you have 72 hours to determine what happened. And that's a very, very short time, especially if you're dealing the millions of records. And so you've got kind of those two things. And I think on the compliance side, there's a big push right now in the information governance world to really classify and understand what data you have and where is it. And this is something a lot of companies are struggling with, is trying to figure out where things live and where their risk is, because they need to try to A, defend it, B, detect it quickly, C, mitigate it, and if there is an actual breach, quickly know what's actually inside of it. So we do see it quite a lot in compliance, and I think there's going to be a lot of growth in that area in the next couple of years as companies try to figure out how to better manage the records they do have, both in databases and unstructured data.
All right, excellent. So Jason, I kind of look at you as you're part of my kindred spirit. You're the service provider. How are you addressing, as you're looking to provide services to your customers, specifically around machine learning? How do you address these three topics?
Well, I think cybersecurity, privacy, everything goes back to that trust commentary that I made earlier. And it wasn't just trust in the integrity of the data; it's in the trust of what we're going to do with it. It's trusted that we're custodian of that data. As much as I'm lucky enough to look at a federated view in a more horizontal fashion across a multitude of banks or credit unions and offer them sort of kind of peer intelligence and support if there's interest, there's also got to be dedicated trust and privacy between financial institutions and their service providers in a one-to-one relationship. Because let's also remember, like Tony had said about, commoditization of what's occurring in the financial services market. Well, we have to work with each other to provide differentiators. And in that, I think is intent based around privacy of the data that we're custodians of. I think things like cybersecurity, et cetera, they're second nature to us because they have to be, because we've always been housing those systems. And now that we're doing things in a digital environment, being able to react to them faster. When we talk about earlier, we had mentioned just fraud briefly. Fraud, I view under a security model, not all out cybersecurity, but when you see an activity or a behavior, that creates an issue that goes under that umbrella. So I think looking at it in that realm is something that we have to do as service providers. Otherwise, our value proposition in the mix as such is not anywhere near as high as we think it needs to be. I think trust in that realm is first and foremost.
All right, excellent. And Tony, you're representing the customer. So what's your view? How are you dealing with this? Because you're actually implementing machine learning right now. Yep. So why don't you give your insight?
Yeah, so around cybersecurity and fraud, and absolutely the biggest spike right now this year has been bots attacking across the sector, not Redwood necessarily, but across the sector, bots have been employed. And really you need AI to detect the bot. You can come up with all sorts, but at the end of the day, you need an engine that's actually detecting, and it's not looking at it after that as real time. And so that's one of the challenges as you look at AI. How do you move from an analysis where you get an answer and then you apply that to real time analysis? And that's where you're starting to see AI being deployed. Similarly, Jason and I were just talking the other day about check deposits. The biggest fraud area right now, and for most banks and credit unions, happen to be PPP and unemployment fraud, where the fraud's perpetrated against the state or the government, but the funds are being deposited into a financial institution, and knowing that the funds that's being deposited might potentially or likely, highly likely, be a fraudulent deposit or a fraudulent some fraudulent funds is certainly an area that we're using some artificial intelligence and looking to do more. Is the behavior changing, especially in mobile deposits where most of that's coming in, and they're using unsuspecting members and unsuspecting customers of banks as mules, basically, with a promise you get to keep half the money, and et cetera, et cetera. So how do you support the member? At the end of the day, for us, everything revolves around how do we support the member and protect the member. And so protecting them from being defrauded is one of the biggest areas where we see. We're actually doing a lot of work actually with your company, Blair, around delinquencies and charge-offs. That's an area that's ripe for AI. I think that we can do a much better job. It's not about us protecting the loan so that we can get, because at the end of the day, most of our loans are highly collateralized. It's about protecting the member from falling into a delinquent status. And so how do we help alert them that they're going to fall into a delinquent status so that we can protect them and their finances? Those are the areas that we really want to see AI being utilized in supporting the member. Fraud, financial awareness, financial savvy, areas like that. Somebody asked a question about verticals. There's a lot of verticals in banking that AI could be used and used effectively and used for good purpose.
Okay. All right. We'll go to one of our last polling questions here and begin to wrap up with one of our last couple of questions that we have for the panel. So if the team can put up the last polling question at the moment. So we've talked a lot about, let's say, a number of different use cases. And I know, at least when I've had the opportunity to not only discuss today's summit with you guys, but just in general, one of the anecdotes or one of the topics that I always mention is, especially when you're using an AutoML solution, being able to produce a model, for all intents and purposes, is becoming not only more and more commoditized, but it's relatively easy to produce a model. I know that we've had the opportunity to work with your guys' organization, and once we have the data, we can produce a model in probably in less than an hour. But in the end, the value really begins to come when you can take that model and you can implement it into your ecosystem, or you can, in effect, begin to bring those services to the fingertips of your customers. So I kind of have a twofold question as we begin to kind of wrap it up. And we'll start first with you, Jason. What are some of the opportunities that you see ahead of Alogent as it relates to machine learning? And where do you see this going in the next 5 years?
I think that's a really easy question, because that's what we try and predict. The whole nature of this, right, turns into prediction. I think first and foremost, what we got to look at is, like Tony had said earlier, about the question isn't always the question. You'll get the exactness in the answer that you're seeking with the question. You need to look at things in the periphery. So I think for us, seeing a multitude of behaviors and questioning what contributes to that is something that we're specifically doing when you talk about, when you ask about us as an organization. I think financial services, for us overall too, when we mentioned fraud before, things like if we go back to our lineage and check deposits, right? So we talk about, we were able to build what we feel are predictive models, right? And it's most rudimentary set based on rules, like we all did over the years in a multitude of other industries and verticals. We built them off of rules. Making those rules move into now the machine learning era, I think is very important. It's going to occur sooner than later. It's occurring now, but it's going to reach a point of maturity quicker, because we could stop a lot of things when it happened, right? It was great. We were like, oh, this is going to happen. Stop it. Great. How do we reach a point where we're going to start to see the conditions that are going to occur with that? So I think when you do that, you automate, and it creates different efficiencies throughout the model in the ecosystem. So other things can then be done in the organization. I think what else will change is really predictive parity, I guess we'll call it, will close the gap over time, right? So if we can do something through a set of rules in a more, in a less cognitive way, but more just rudimentary, and say we can stop 80% of it, well, getting that predictive parity closing over time, I think that's where it's really going to engage machine learning, AI, and then that journey into prediction overall will just be, I think it's where we all want to be. I think it's the right place to be. I think because we want to automate a lot of those decisionings, and then we put smart people doing the right things with the right customers during those times. I think that, if anything, being home for everybody has taught that, right? Like not having people around to touch and exchange and to discuss something in office, for instance, or help a member, really important. So to be able to take that predictive parity and close that gap, I think is important. And I think holistically is the number one thing I can leave it with Blair, because I know we've, like you said, from a service provider perspective, we've traded a lot of cool conversations about what if, right? I think it's limitless related to that. But I think we can't put any data in a silo. The danger that I feel is that we're going to put data in a silo. And I think that was the one question related to verticals, right? So we're gonna look at data and behavior inside verticalized silos. There's going to be machine learning tools that are inherent to each of those silos from service providers, and they're industry wide today, and they're awesome, right? It can be anything from chat to fraud to marketing, all of that. But I think the real cool thing's going to come when we take all of those and we put an enterprise layer and look at them in a more federated fashion, and not say, because all we're going to do is build silos of point solutions to fix point problems. We take those and put those across the enterprise. That's where I think the magic's going to come. Then you can predict all of that going on. And then when you sit back and see what's happening inside your bank or credit union, it's going to be pretty awesome.
Couldn't agree more. And if I would say, I think Alogent is well positioned to begin to provide that view and service moving forward. So look forward to it. And Richard, what's your view as it relates to some of the immediate opportunities, and where do you see this going in the next 5 years?
From my perspective, I see a lot of employees doing bad things on their computers because I do a lot of investigations, and this, it doesn't stop just because it's a bank. And a fair amount of the cases I do are misappropriation of either trade secrets or client data in some cases, or models. So we see, employees that take this data, and one of the things that is starting to take root is data loss prevention tools, although those aren't really that smart. They're rule-based, but they have to be very specifically tuned to types of data that you're finding, and there's not really an insight that suggests someone's going to be leaving with data. And so what I think is going to happen in the next 5 years is there's going to be more of a push towards linking endpoint, that being computer activity, to likelihood of leaving, and it's going to combine with potentially some of the other data points that are already being done, like LinkedIn. Trying to find out. There's some company out there that kind of does analysis of LinkedIn profiles for employees to determine if they're likely to leave soon. And so I think once you have alerts from that kind of a system, you can also combine them with what are they doing on their computers to actually say, oh, it's interesting, they haven't used a USB device in the last 3 years they've worked here, and suddenly they used 10 in the last month. That's a red flag, and we should probably intervene and have their, be more proactive about making sure data is not going out the door. I've seen everything from, I can't go into it because there's not enough time, but let's just say people are they get very
creative,
smart about how to get data out of an environment. So I think there'll be a push towards stopping that in the next couple of years, and really learning from, the huge sample sets that you have across an organization to say, hey, this seems like a strange thing for a USB device to be plugged in and then 50 files are accessed in the next hour. That's outside of the norm. Flag that, have some some reporting up the chain, so you kind of are aware of it beforehand, and you can stop data breaches of customer information or losing valuable models that could be extremely commercially valuable to you as a financial institution. So, and we've seen this everywhere from wealth planners to traders of commoditized energy. So it doesn't just stop at the client, the consumer banking level. It goes all the way up to trading. So I think that's where we'll see it go, at least with this industry.
Okay. All right, Tony, let's hear your view.
I'm going to keep it very simple for everybody, but everybody listening will probably recognize that what I'm about to say is simple, but it's super complex and requires machine learning to actually pull it off. We're very good today at rules-based engines. We can auto-decision any loan we want based on rules. We can auto-decision anything we want based on login, based on, you name it. We're good at rules-based. We're extremely good. And those rules-based are typically built based on predictive models. So rules-based is easy. What we need to transition to is response-based. This is where AI and machine learning will actually come into play. Today, rules-based. Tomorrow, response-based. And the only way you're going to get to response-based decisioning is by having an engine that can actually drive that in real time. In other words, you're not just using a set of rules to make a decision. You're using responses to who and what you know about that individual and their behaviors, and some of what Richard and Jason have already talked about, all married together to make a response based on not rules, but based on behavior. That's where I see us going. And yeah, I think it's going to be further and further embedded into the environments. The only way credit unions and banks are going to survive is by having solid plans and designs around AI that drives to the individual, not to the institution. And I think that's the other challenge that's going to happen in the future, is how do you focus on the individual versus the institution? So moving from rules to response-based decisioning.
Excellent, excellent. And I look forward to working with you as we move in that direction. And the same with you, Jason, as well as you, Richard. And this kind of leads us into our next session. We'll end up with just one last poll, and we'll move into what I call our innovation in action section briefly, where we'll just take a few minutes to kind of share with you guys some insights to how machine learning can indeed bring a tremendous amount of value to your organization. We actually received a number of different questions around explainability, how you can begin to use the platform, whether it's looking to do member attrition, whether it's looking to do next best offer, et cetera. And what I wanted to do was just briefly begin the process of just sharing with you, really kind of to a large degree, how simple and how effective machine learning can be. I think we've all kind of highlighted, especially Tony and Jason, where they've mentioned the importance of being able to actually not only get something that's actionable, because being able to produce a model, we certainly believe is democratized and will continue to be democratized. But more importantly, being able to take that information and actually use it, and specifically around explainability. So one of the areas, and we've kind of made sure that we've protected the guilty, but we've really made an effort to kind of streamline our interface, really to kind of hone it down into really three very distinctive steps, where number one, you upload your data set. Once you establish what you're looking to predict, and let's say in this particular case, if you're looking to understand if whether or not a customer may or may not become at risk, specifically as it relates to defaulting on a given loan, one of the things that we do is we certainly not only work with our partners, but also our customers to give some insight as to what information is needed in order to be able to do a prediction. And a lot of times I always like to say that it's always better to start wide and not necessarily deep. So we've kind of welcomed where you bring all of the features that you may have regarding what you're looking to predict. And one of the things that our platform does is it'll kind of narrow it down and help you identify what are some of those features and that data that is actually influencing your prediction. So we may start out with let's say an extremely large or extremely wide data set, and then at that point, we'll begin to give you some insight as to what information or which data is actually important to a given prediction. So in this particular case, we're looking to identify if whether or not someone will actually default on a loan or if whether or not it'll be charged off. So we provide a fairly large explainability office, which one, we have what we call our exploratory data analysis, where it gives you all of the in-depth insight to the data that you've provided. But just to briefly kind of start first, we also provide what we call this feature importance matrix. And this feature importance matrix, especially when you're beginning to think about explainability and beginning to think about what's driving your predictions, you can begin to look at some of the visual graphs that really highlight what are the top 10 features that are influencing a given prediction. So in this particular case, we see the loan origination rate, we see the transaction count, we take a look at the balance. These are all of the features that we've identified that may be influencing your prediction. And then to the contrary, which can also equally be important, is what are the features that are really not having an influence on your predictions? Because sometimes we may go into a particular situation where we believe certain sets of data is really influencing our customers' behavior, but in reality, we find out that actually it's not influencing. So this is something else that we'll provide where we say, hey, maybe you've provided, let's say 100 features to help make a determination on a given prediction, only to find out that maybe 30 or 40 of those features really don't influence your predictions at all. But one of the things that I would really like to highlight, because we got a lot of questions on this, is explainability. An ability to, once you actually conduct a prediction, to be able to understand what is actually driving that particular prediction. So when you look here, you see a couple of different things. One, you see the accuracy of the model that we're using to predict on. In this case, it's 96%. And then we have what we call this model to data relevance indicator, which is also extremely important because it begins to give you the indication on if whether or not your model or your predictions are decaying, right? So we don't want to make sure, we don't want you to end up in a position where you're doing predictions and your predictions are becoming erroneous. So we give you some insight as to if whether or not you need to retrain your model. So in this particular case, if there's a 1, this is someone who's actually eventually defaulted on a given loan. So here we can go into what we call our model interpreter. And one of the things that I mentioned, and I believe this is extremely important when it comes to explainability, is being able to directly understand which one of your features, or more importantly, how those features are actually influencing a given prediction. And one of the things that we do is we allow for our customers to dynamically change the value of these features and see how it may influence the actual prediction. So if you take a look here, we have a 98% belief that this particular customer will default, right? And what you can do, so you have these different features. You have the loan original rate, you have the transaction count that they have. And so you can quickly just see, well, how would the member be influenced if their rate was different? Or how would they be influenced if the number of transactions change? So quickly you can come here and you can just simply just change the value of that feature and see at what point now does a customer come from being at risk to no longer at risk. And you can use this tool as well to begin to identify profiles of your customers, where you align and you identify a profile where, for all intents and purposes, whether you're identifying a profile where customers become at risk or whether you're identifying a profile where customers are no longer at risk. So we've really put a tremendous amount of effort in making sure that not only can our customers do predictions, but also they have the necessary tools so that they can not only take actions on those predictions, but also that they can explain those predictions to the business. And I just kind of wanted to begin the process of wrapping up our discussion here today with just providing a little bit of insight in regards to certainly why we believe explainability is extremely important, and also how we begin to address explainability in some of the tools that we're working with Redwood with as an example. And as we begin to wrap up today's discussion, I not only want to extend my thanks, but we would certainly like to open it up to the audience to see if you guys have any more questions for the panel. And you have two options. You can digitally raise your hand if you like, or if you want, you can type a question into the chat, and we will direct it to the most appropriate panel member. And so I will, at this point, begin to take a look and see if we have any questions out there from the audience. And I do see that there is one hand that is raised. And let me see if I can navigate to this gentleman. I'm on the wrong screen. I will go here. So Jibby, you are unmuted, so you should be able to unmute yourself on your side and ask a question.
Great, thanks so much, Blair. I have a question. So yeah, the platform looks pretty interesting to me. Is this something that we can get from our service provider, or something that Alogent has exclusively for their clients?
I would assume that's my question, Blair.
I would gladly hand it to you.
I just wanted to respect procedure here for you. That's all. Yeah. Overall, the tool, like as exhibited today, yeah, that is something that is available from Blair and his team. The data and how we're utilizing it and all, it's kind of this group effort together. So we house the data, we are creating models and such and use cases, and working with Blair's team on creating those models of interrogation and presenting applying machine learning to it. So the machine learning component of it is Blair, the data assembly, interrogation, and then being able to see what's predictive after that is us, and we do that together as a collaboration.
All right.
Did that answer your question?
Thank you for that.
Yes, thank you so much, Jason. Appreciate that.
Yeah, no worries.
All right.
You're welcome.
Okay, so I will go to the Q&A. This is a question from Cal Yu. It says, is anyone working on predicting governance failures in financial institutions or banks? So maybe let's go to Richard on this. Maybe you might have some insight into this particular question.
I wouldn't say governance failures. I would say, you know, like what I mentioned before, some of the compliance side, and maybe that's what you meant, but the compliance side of, you know, knowing where your data is at and whether you're complying with data privacy laws for data transfer. I think that's probably the closest that's being done right now. I don't know that there's any particular, I haven't heard of any machine learning regarding like regulatory compliance. So I think there's, depending on what type you're talking about in terms of governance, I think there's a different answer. But I do think from the side of understanding where your customers and employee data is, there's certainly already, you know, a big wave doing that, especially for the larger banks that have multi-jurisdictional locations, customers or employees.
Yeah, I was gonna add on with Richard too, because of that. You see, there's things related to testing inherently, like OCC testing, or, you know, whoever your regulatory authority is. Automation can come into play there. I think if you look at it as a model, so say if you do something that's regulatory, that someone in DC makes, and do we have a model that then applies it, runs it out to predict the nature of it? I don't know of anyone actively using that day to day today.
Yeah, I think the question is how you define governance, right? So if you're talking about governance from an enterprise risk management, if you're talking about it from a regulatory, you know, are you using BS? Are you doing BSA? Are you doing all the? Are you following the rules? there's not a lot of AI out there, and I'm not sure there's a lot needed. It's an on-off switch in some cases. There are a lot of tools out there that people are using to track their governance. If you're talking about a governance from the sense of the financial viability of the financial institution, that's a whole nother subject. There are about 17 off the top of my head, more than that, but there are 17 main indicators on the health. And yeah, there's a lot of people applying data analytics to those 17 factors to determine the health or viability of that particular financial institution moving forward from financial. And one of the things they're trying to do is predict into the future what's going to happen with the rate. So rate risk is probably the biggest risk for most financial institutions, as well as fee risk. So what most people are trying to do is what is the rate risk going to do to your net worth and to your capitalization of your credit union or bank? And so, yeah, there are several models out there. I don't know that anybody's been, there's one company that I can think of that's really good at doing that. It happens to be a company called C. Myers. And I'm not sure if they're using an AI engine to do that, but they're very good at predicting, where are the triggers going to be where this particular institution's going to run into challenge with their capitalization, for instance, is one of the factors.
Okay. I will switch over to another hand that's raised. Thank you for the response, Tony and Jason, all of you guys. So let me allow for Alex you should be able to unmute yourself.
Hi, thank you, Blair. My name is Alex Gutierrez, and my question's for Tony. Tony, how has using machine learning helped you in making better decisions as it relates to credit risk when you're rating one of your members?
Sure. We've just started looking at that more aggressively. So I wouldn't say that it's done a lot for us yet, but we are experimenting, and some of it we're experimenting with Blair. I mean, one of the questions that he's looking at right now for us is this whole, actually the thing he showed you is, default likelihood. We are looking at credit migration. We have credit portfolio management that uses a very, I would say, weak AI engine, and that's one of the challenges with your portfolio risk management systems that are out there. Their use of AI is pretty limited. A lot of them are still rules-based. So we're literally looking for those players who are going to drive towards more of an AI engine, because then once you have that, you can apply it down to the individual. And that's one of the biggest challenges for all credit unions and banks. And Blair, I'll just kind of end with this concept. One of the biggest challenges is the amount of data you actually need to apply to an AI engine to get a meaningful result. Blair's team's been very good at figuring out how to do it with, even and we have a ton of data. Let's be very clear. The size of our credit union affords us a lot of data, but you need more. And you need more data that's not necessarily housed within the credit union, because there's several factors that determine creditworthiness, some of which you happen to have, some of which you don't. And so accessing, non-credit union-based data, some social data potentially, but also, looking at other sources of data to include, what's on their credit report and what's historically been on their credit report would be areas that could help. But it is one of the biggest challenges, is the sheer amount of data you need to build solid predictive models. And I think Blair's team's been very successful at using limited amount of data to drive that. But yeah, that's one of the biggest challenges right now in financial services, especially for smaller financial institutions.
All right, excellent. And I'm gonna jump over to the Q&A, and then after the Q&A question, I'll come to you, Paul, on the audio. So there's a question in here from Jim. Admittedly, there are data privacy implications to consider, but do you anticipate more cooperation between companies, industries via AI, ML versus less? And I think Tony, Jason, I think either one of you guys can easily take this one.
No, maybe.
Yeah,
That's a good question. I come at some of this right?
Yeah,
So,
I mean, how do we get here? I mean, honestly, worked with Tony in the past. Blair, you and I met over all of this, right? And just finding commonality in how we see the world, right? So it turns into business and ideation. So, I mean, that's a big loaded question, because I think it's going to depend who you're working with I think you pick people that see the world a little bit like you want to see it and start working together, and what comes from that. And I think those people will exchange ideas and not feel threatened by it. I think there's going to be other factions that you don't celebrate that in so much. And I think it's all who you're going to choose to work with and partner with. But Tony?
Credit unions are fairly cooperative in nature, so they do tend to work together more than banks do, obviously, and certainly credit unions with each other versus credit unions with banks. You can find that in stuff like Callahan, which you can go see you can slice and dice and compare yourself to any other credit union you want right now fairly quickly and easily. Applying that to an AI model and applying historicals to that AI model would be interesting. Do I see that happening a lot right now? No. But I do know a lot of people use pure data, and I know a lot of credit unions cooperate with each other. I know certainly Jason and I have talked about the wealth of data they happen to have at their fingertips because they're hosting a lot of online banking users. And to be able to use that vast amount of data to come up with models that then can be applied to the individual credit union would be fascinating. And I think that's one of the value propositions that some of the online banking providers could actually leverage. Are they doing it today? I'm not sure they've figured that out quite yet, and they'd have to figure out some non-competes and NDAs between the institutions. But I do think there's some opportunity for it. I don't believe that most small credit unions or banks are going to be able to do AI effectively without doing some level of cooperation to get enough data to have meaningful results. But that's just an opinion that I have. Blair's proven me wrong several times, so I hesitate even saying that out loud. And I just want to make sure you all know I dyed my hair to match the background of this particular slide. I'm very motivated to try to appease Blair since he's proven me wrong so many times.
Oh man,
That's all it takes.
Excellent job, excellent job. We do have a question from Paul. He mentioned he might have some microphone problems, but Paul, are you able to ask a question to the panel? It looks like he may be having some problems, so maybe he might type his question. All right, so we'll give Paul a few seconds to see if he would like to ask a question in the Q&A, or if he can get his, oh, we have an anonymous question for Alogent. It says, is Alogent implementing AI within the, and I didn't write this. I'm not anonymous, Jason, just so you know.
Hey, Jason, I'll just ask it. I won't be anonymous.
Yeah, it comes across a lot less threatening that way, doesn't it? Yeah.
Is Alogent implementing AI within the digital banking platform? If so, I missed the earlier part, so I apologize if this was already asked.
It wasn't asked because I made sure to stay conceptual and thought leader here and not just talk about what we do. But the direct question is, yes. I could say it's not just in the digital banking platform, how we're looking at it cross company, right? So even earlier I told you when we look at things like fraudulent information and things like that and how to act off of, akin to what Tony had said on rules-based to not. We've taken models for machine learning and AI into a customer scoring perspective instead of just, very specific small indicators, but start to look at behavior. That then parlays into our digital banking platform. And I think the easiest way to look at that right now, implementing it in some instances, is related to things like marketing, quite first and foremost, easy grab there, looking at customer activity behavior, nudging them along through their journey on using the application. I think it was on one of the calls we had with Tony, we learned about, those people, they literally log into their banking app 9 times a day, 10 times a day, 20 times a day, checking balance, flipping, going back down. It's that what you do when you have your phone in your hand. So that's an opportunity to engage someone. So being able to do that, but absolutely. Now I can tell you also in our platforms, modernizing the platforms that we've had to be able to take data out in a more readily used format. I'm sorry, I stumbled through that. Is really first and foremost, so that way we can have a clean journey on the data when we apply it into machine learning. So I also think that frankly, that's a problem with a lot of legacy technologies. got a lot of junk out there you're trying to get through. I think one of the things that Blair does well is he can tell you some of the junk you don't need and why throw it out, and it doesn't matter. I think having data be able to come together from an application is where we're actively doing now, more than anything, because if not, it's going to obfuscate the journey completely. You know, it's going to start off messy to go. So.
Okay, all right. I think we are not only past our limit, but I think we are also at the end of all of our questions from the audience. So I would like to again extend my appreciation and thanks to our panel, Tony, Richard, Jason, for taking the time out. I know that it's hard to nail you guys down, especially in one place at one time. So thank you for sharing your time with us, your insights to the audience, and as well, thanks to all of you guys who have attended today. We certainly appreciate it. I know that we went a little bit longer than planned, but hopefully you guys were able to get some insight out of our discussion today. So once again, please be safe, and we certainly appreciate you guys taking your time to spend with us today. So thank you very much, and have a good one. Thank you.
Thank you.
Thanks.